Thank you very much, and good afternoon everybody, and welcome to Wellington's Q3 conference call. I'm Howard Milliner, Wellington's CFO. Wellington released its Q3 result last week. On this call I'll make some comments on the performance for the quarter, the expectation for the 2017 year, and also some additional comments on how we see 2018. Greg will then provide an update on the business and specific business development opportunities. I'll start with the usual warning. We'll be making some forward-looking statements on this call today, and as these are predictive in nature, they are subject to a number of risks and uncertainties relating to Wellington, its operations and markets in which it operates. Some things are beyond the control of Wellington, and actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. Perhaps the most pleasing aspect of our performance over recent years has been the revenue growth trend. Wellington has now delivered 10 quarters of year-over-year growth, going back to Q2 2015. There is no reason to believe that this trend will not continue in the future. That's what we're working very hard to deliver. As stated in the NZX announcement, the EBITDA result for Q3 was lower than expected, largely because of customer product mix. Q3 is always a low volume quarter for Wellington due to Northern Hemisphere summer factory shutdowns, so mix can have a big impact on gross margin EBITDA performance, especially in our business where most of our costs are fixed. There are, however, many highlights, and the outlook for the business remains very positive. Revenue. In New Zealand dollar terms, revenue increased year-to-date from 25 million in 2016 to 31.6 million, a 26% increase. In US dollar terms, it was a 28% increase. In volume terms, we shipped 14% more EC motors and 2.6 times as many SCS controllers as we did in the comparable period last year. This is a continuation of the trend in recent years, quarter-over-quarter revenue growth, and it is where we are primarily focused at present. There was strong growth in the Americas, driven by increasing ECR2 sales to USA customers and higher SCS Connect volumes into Latin America for major beverage brands. APAC revenue was flat compared to 2016, and EMEA recorded lower revenues. SCS data revenue is becoming increasingly important to the business. Year-to-date, we recognised $136,000 of data revenue in the result, and there is $800,000 on the balance sheet at 30 September to recognise over future contracted periods. Data pricing is included in the SCS Connect invoice price, which means Wellington is receiving payment up front for long-term data service contracts at the time the hardware is supplied to the OEM. $938,000 has been invoiced to date since the commencement of product sales late in 2016. Greg will talk more about proximity-based marketing services currently being trialled, which we expect to generate additional service revenues over time. We have reaffirmed revenue guidance for 2017 in the 25 to 35% revenue range. At this stage, we're on track to achieve this, albeit at the lower end. Q4 looks like being a $12 to $13 million revenue quarter, similar to Q1 2017. Gross margin improved by 0.3% to 23.7 year-to-date. The performance year-to-date has been a bit lower than we expected, largely due to delays sourcing lower-cost SCS production from the East-West facility in Vietnam. This is now resolved. We have achieved the expected cost reductions for our ECR2 motor, although supplier pricing on legacy motor suppliers on legacy motors have been increased slightly due to increases in commodity prices. We are seeing commodity prices increasing, particularly in the silicon market, as supply tightens up. Profitability, EBITDA year-to-date was $59,000, impacted by lower volumes and reduced gross margin percentage in the quarter and higher operating costs. OPEX costs have increased $1.6 million compared to the same period in 2016 due to increased sales and technical headcount to support our new products and increased marketing costs. As previously stated, we continue to invest in customer-facing growth skills and software development skills in New Zealand, which is helping to deliver our growth and profit improvement. We expect further investment in 2018. Year-to-date, the EBIT loss is 1.2 versus 1.6 last year for the same period. We have issued EBITDA guidance for the 2017 year at 1.5, the lower end of previously issued guidance. We've already seen revenue move from Q4 to Q1 as OEMs delay their orders. This is a response to brands not finalising their cooler orders for Q1 until much later this year. We're still waiting in some cases. Chinese factory closures for New Year are also later than last year, so there's not the same pressure for OEMs to take delivery of product in December. We're obviously doing everything possible to supply volume in Q4, but we don't believe we should be pulling in Q1 revenue just to make the quarter. The revenue is not perishable. Cash and working capital. We closed Q3 with 1.2 million of cash. We drew down the final 0.5 of the Smart Shares loan facility at the end of the quarter. Cash management is always a challenge in Q3 as we pay down payables from Q2 trading, and so it proved again. A loan facility was secured from Meta Capital to secure some headroom. This facility and strong forecast revenues in Q4 mean that our cash position is acceptable as we enter 2018. Inventory was 3.5 million at September, a 0.6 million reduction compared to that at June 2017. We're planning to position inventory at year-end to ensure we make use of available capacity in Q4 to meet expected demand in Q1. These decisions are being made on a case-by-case basis where we have confidence customer demand will be forthcoming. We don't want to leave revenue on the table because of reduced capacity available in Q1. We have confirmed guidance for 2018, EBITDA in the $2 to $4 million range, and a bottom line profit. This is consistent with previous guidance and reflects revenue growth in the same range as we saw in 2017. We're still receiving customer forecasts for 2018, hence the wide range. Revenue forecast for Q1 looks strong, which should mean we start 2018 with a strong first quarter result. At this point, I'll hand the call over to Greg.
Hi everyone, thanks for joining the call and your support, and thanks for reading the latest market release. Whilst we did have our expected low point in Q3, and that hurt a bit, we are overall quite pleased with the way the year is working out and how strong Q4 and Q1 2018 are looking. In the latest release, published a few days ago, we talk about revenue moving out of Q4 and into Q1 2018. However, we don't see this as a bad thing. It's still revenue growth, and we can still deliver it for our customers, and as Howard said, it's not perishable. If we end this 2017 year even at the low end of guidance or slightly under, we would have improved EBITDA by over $1 million year over year. We would have delivered solid revenue growth of around 20 to 25%. I still like to remind my team, think back to a few years ago when we were struggling with $14 million of losses, costs were out of control, and we weren't innovating with the kind of products we've got now. And I think we all like to say that those days are far behind us. You probably realize as well that it's not typical for us to get out in front of next year so early and project net profits. We first signaled a net profit target at the interim report, and we have enough confidence in the business now that we are willing to confirm that projection again in the latest release. I think you can take that level of confidence as a sign that our products are being adopted and customers are pulling them fast. Yes, we still have a lot of work to do to market the customers, train and support them, but we are winning new customer business. Evidence of this is shown in our SCS business volume growing by around 260% year over year, and the booking of close to $1 million of data services revenue to date. SCS data revenue is becoming an increasingly important part of the business. We think it's a great business model. We actually negotiate and then deliver multi-year services contract with customers because they need certainty in platform and solution, and the data pricing is included in the overall pricing for the system. It's cash generative, and it's a model that we think will continue to develop as we add more digital services such as beacon tools that are provided by our partner iProximity. On that point, our digital solutions business is launching with the help of iProximity, with broadening customer discussions and a particularly impactful trial happening with a major brand and some large Latin American supermarkets. With our data services through SCS and the digital marketing business, we're moving from the cost side of our customers' ledger to the sales side, where we help them sell more food and more beverage. So we think the value-added opportunity is high. You may have noticed in the latest release I talk about our Smarter Cooler brand. Our Smarter Cooler brand is how we describe the bundle of services that we've developed to connect and manage our clients' fleet of coolers and help them sell more product. We think we have one of the largest installed fleet of beacons inside our SCSs in bottle coolers in the beverage space globally, and those beacons will allow us to develop and deliver all kinds of value-added services to clients over time. So our transformation away from a commoditized hardware business to a hardware-enabled software and solutions business is well underway, and you should expect this transformation to not only deliver ongoing top-line growth, but profit expansion. It is fair to say that the rate of improvement in our top-line growth may track faster than the rate of improvement in profits, but that is because we are very focused on adding the new sales, software development, and marketing skills needed to build a software and solutions business, and that is critical for our long-term success. We've not given up on the hardware business, but it is now more of an enabler for the software and services that we're developing with partners such as iProximity. We'll continue to develop new partnerships to expand our offering. For example, that could include image capture and image recognition, and it also could include further development partners and leveraging outsourced development to expand our offering. I recently visited a large beer brand and was walking them through both our EC Motor and our SCS Digital Solutions roadmap. I presented our SCS Connect technology, and I demonstrated how making their coolers intelligent with SCS Connect, we can connect with their consumers in front of the cooler. An example they gave me is they have 50,000 unconnected coolers in a particular region, and they'd love to connect them. These are already deployed. They want to connect them to the cloud, both to track the cooler, but also to communicate with the consumer and sell more product. We have an aftermarket connectivity device called SCS Click, which simply does that for installed coolers, both cost effectively and easy to install. And I'm sure they'll start buying that aftermarket device next year. So we're very focused on continuing to communicate effectively with you all, and that includes quarterly updates and regular insights, whether they be great, good, or not so good, like Q3, into our business. The resolution of our business and customer demand means that we will have the odd weaker quarter, and that will typically probably be quarter 3. We will not be going back to the days of being an industrial motor company, although we will still develop high-tech motors to complement our overall smart cooler solution. Essentially, we now think of ourselves, as do our customers, as a tech business, providing wireless connectivity and software solutions to the world's largest retailers and brands. We not only help them reduce costs, but we're helping them manage their refrigeration assets and grow product sales. So we think we're on the right track. We're fundamentally stronger. We're growing faster than ever. And we hope and trust you can see the continued growth opportunity and you stick with us as we navigate this new and exciting space and business model. Thanks, everyone, and I'll hand it back to the operator for questions and answers.
Thank you. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, that is star 1 to ask a question, and we will pause for just a moment. And our first question will come from Roger Armstrong, a private investor.
Hey, Roger.
Hi, how's it going, Greg? Hey, just my first question is one about costs. Just eyeballing your movement in EBITDA versus your gross profit. It looks like you've added $1.5 to $2 million in costs this year. And on the call, I think you intimated that this trend may continue, or I wasn't quite sure whether your comments were pertaining to next year or whether you thought you were at a reasonable standard now. I just wondered whether you could tell me how much of this is actually going into investment into new products and new revenue streams, and how much is it there just to help the sales process along?
Look, we added, I think we mentioned in the disclosure how many discrete headcounts. Was it 9, Howard, I think? Year over year. Anyway, yeah. Just look that up for me. So it's going into 2 main areas, Roger. Software, not motor development, software development, so software and solutions that support our SCS, and the marketing and customer support. Because as we, let's say we ship 50,000 SCS Connect devices into a brand, we have to then train the brand, train the botler, and train the manufacturer of those devices. And we've got a whole reporting model, a data system that we're charging for, as I've mentioned. We're also training and helping that brand on how to use the information to better manage their fleet and improve sales. And then, and we call that marketing support and training. So one of the things we realized up front, we do need to broaden our software offering, and that's opening new streams of revenue. We're doing some of that through partnerships like with IPX, but, we've added 2 new app developers in Auckland, and 2 great people who are helping develop our apps, and those are apps that we sell and deliver to customers, but we're also leveraging outsource app developers. And then one of the things we realized up front is we can't just ship not just an electronic device, but an electronic device with data services without the appropriate market support. So our in-field organization it's probably going to double, maybe triple by the end of next year. So we'll continue to add software development specifically and customer support as we win the customer. We're not actually going out and kind of adding 10 people and then hoping we win a customer. There's a bit of a lag. We win a customer, there's a lag to them adopting, and then we would hire 1 or 2 field support people to train and support those solutions in field. Does that make sense?
Yeah. So what you're telling me is I've got to continue for you to add more costs. That if you add $3 million of gross profit next year through having a great sales year, I can't expect that $3 million will pass the bottom line. That you might have to give a reasonable percentage of that away in terms of just continuing to build your business.
If we added $3 million on the current products, because obviously we're adding some new resources to develop new software tools, which we'll charge for and will add to revenue and margin. But on the straight field support, I'm just using a rough number. If we added $3 million of sales, it would depend. Like if we added $3 million of sales to a customer we're already supporting, like one of our largest brands that we started shipping to last year, Roger, we probably wouldn't add any more cost to support that customer because we've already got the install, we've already got the people in the field. But if we want a brand new customer, say in the beer market, in a new region where we had no support, we'd add 1 or 2 people, maybe 100 to 150 grand worth of headcount in that new region with that new customer to support it.
Right. Okay. All right. So, and one other question. You talked about having, I think, $800K of prepaid data revenue sitting on your balance sheet to put through the P&L as you earn it. I was just looking at your accounts, and you actually had deferred income going back in June 2016 of 450-odd thousand. Has there been a sort of change in mix there, or did you actually have some of this revenue booked over a year ago?
It's different revenue, Roger. The older balance relates to a development product we did for East West. And right. There's a license in respect of that product, and when East West sell units, then we will earn revenue, and it'll be released from that deferred revenue. So it's deferred revenue, but it doesn't relate to the data product we're talking about now.
So the 800 grand you're talking about, you basically added that all this year, so you'd expect that balance to continue to increase at around that sort of rate. Is that fair?
Absolutely. Yeah, absolutely. Most of it was this year. There was a little bit, obviously, when we started 2016, but it's. Right. I think we said there was about 900,000 of invoicing this year, and we'd expect that rate to continue to grow. So flattens out revenue.
I don't want to overplay it, Roger, but that's our kind of current. That's the data platform that we developed in Wellington. But as we start to sell our partner iProximity services, that's obviously more services revenue that'll run on a similar model with kind of long-term service contracts.
Okay. That's great. Thank you very much.
No problem, Roger.
And there are no further questions at this time. But as a reminder, that is star 1.
No one else has questions? I'm surprised.
And there are no further questions at this time. We do have a question coming from Grant Taylor. We do have a question from Grant Taylor from SB.
Hello, Grant.
Your line is open.
And you're on mute.
please check your mute function. Your line is open.
Technology, it's a wonderful thing. Greg, the last 3 calls that you've had, you've which is a great thing to do. You've opened up the questions afterwards, and each time you've been surprised at the lack of questions. What are the things that you think we're missing?
I guess I just like questions, Grant. Look, I think if I think back to coming out of last year when we were just really launching this new business model, call it the SCS data, and now going forward some of the new services with IPX, just to be transparent, I felt back then that it was pretty new and shareholders, investors didn't fully understand what we were trying to do, and to be honest, we were learning pretty quickly as well. We still are. So I was quite keen to make sure that I explained what we're doing in terms of the business model well, and that give the opportunity to everyone to kind of ask questions. So Roger's question, by the way, on the kind of data services revenue, I think was very pleasing, because that is, and I think has been for a while, our desire to start to build a revenue stream, a long-term revenue stream. I wouldn't quite call it an annuity, but it's not far off, right, around the data services and then new software services that we bring online. We think that's a really powerful part of the model. It's kind of cash generative, and it's kind of long-term commitments from customers. So I think the more we deliver this new model, Grant, which we're doing this year, and we think is going to grow next year, and we're going to expand the service offering, we're going to keep investing in those services, it'll be easier to explain and hopefully pretty easy for everyone to see the benefit from that, so there won't need to be as many questions. So, looking back, I was worried that we didn't have the right understanding of the model. I think that's changing. I mean, you can tell me, Grant, and it's not just results that show that. It's kind of how we describe it, and like the data services revenue, other things like the case study I gave on the beer customer, who are just so excited about how they can connect their installed fleet. I mean, making all coolers intelligent for the brands is our vision. We want to enable every single cooler in the market that can be enabled to be connected to the cloud for our customers. And we're one of the few that can do that. I mean, there's a lot of companies out there that are doing software and services, and that's all great. But we have the hardware to do it. It's deployed actually at scale right now. We'll probably come out of this year with close to 250,000, give or take, beacons in the market. And at the end of next year, with a trailing wind, who knows what customers will buy yet. That's always part of our forecast volatility. But, it'd be nice to think we're closer to 400,000 to 500,000 beacons in the market. So when you get all those beacons in the market and all these assets connected wirelessly to the cloud, and then we can offer all the value-added software and services that tell them where the asset is, talks to the consumer and gives them promotions, tells them if the fridge is operating and when it's going to break down. Holy smoke. I mean, that's just, and there's so much data there. Now, you can't give them all the data. You've got to strip down that data and kind of provide vertical parts of the data and turn that data into information, which we're doing through our reporting tool, which they're paying for. So it's just, we're kind of right on the front end of this transformation of all the assets are now smart. So what do we do with that? And we're already starting to see some of the things we're doing. I'm getting excited, but that's the vision, and we're actually executing the vision. So, look, I get. We had a bumpy third quarter, and we need to make money. We're going to make money next year, but the business model that we're taking the company towards, this kind of connect every single asset in the field that we can, and then add value to that connectivity, is a lot of fun. It's pretty cool to think about it. Grant, did that answer your question?
Cool. No, that's good. Thank you.
I didn't set him up for that question, everyone, in case you were asking. He just asked it.
I just feel sorry for you that there's only ever been one or two questions. I just thought we should have at least another one.
Anyone else?
And as a reminder, that is star 1 to ask a question. And there are no further questions at this time.
Okay. Let me finish off. I mentioned that vision we had, and I'll just finish off with that before we end the call. The beer customer that I mentioned I met in New York, I presented kind of 4 elements to that vision to them, and I'll just leave you with this. I talked about, just before, connecting every single commercial cooler that we can to the cloud. We want to do that. We'll make the cooler fleets intelligent. We'll therefore become the portal into those cooler fleets, the portal, and ultimately will improve product sales for the customers through engaging with the consumer right in front of the point of sale, whether it's soda, beer, food. That's the vision. We're delivering it. We're 18 months into delivering it, so there's a lot to learn, a long way to go. I get excited by it, but so that's the vision, and that's kind of the journey we're on. So I'm really grateful for you, everyone on the phone, to be part of it and stick with us if you can. Thanks a lot for your support.